So first up, we do have Tony Odoviano from Liontown Resources. Tony's a highly credentialed global mining executive with wide-ranging strategic, operational, commercial and corporate experience. Since joining Liontown last year, Tony's overseen the delivery of the definitive feasibility study for the Kathleen Valley Lithium Tantalum project, a landmark $463 million capital raising to de-risk the project, the execution of foundational offtake agreements, and a final investment decision clearing the way for construction, which is now underway. Over to you, Tony.
Thanks, Jane. Firstly, Nicole, if you're out there, you don't need to demonstrate quality by association. You are the real deal, so good luck to you. I stood here 12 months ago as my first diggers, and I presented what I thought was a very exciting opportunity. I'm very proud to be able to present today again at Diggers to demonstrate the work and effort the team has put together to bring first construction on Kathleen Valley. There is quite an agenda that I want to cover, but there are 3 points that specifically I want to drill down on. The market, the ability to demonstrate how we deal with supply, and finally, how we're progressing our construction in this very challenging market. Over this 12-month period, we have laid some fantastic foundations for this company. And it starts with the offtakes. We have secured 3 landmark full-form binding agreements for 90% of our production. 10% which I will look at putting into our spot market as we further mature. I want to develop the spot market because I feel that Pilbara, with its platform, I like the intent, I'm not sure that's the ultimate mechanism, but the fact that we need a transparent spodumene price that is totally dependent on the supply and demand dynamics rather than linked to a chemical price is ultimately where we want to be. Finally, the next point is we've put in place some very attractive financing. Firstly, our capital raise in December, $463 million, and then a further funding arrangement with one of our customers, Ford, on very compelling commercial terms. Construction is underway. We have started digging, and it's only fit that that digging was participated by the land of the people that we operate in, Jual. So we've already started to create value for the Jual nation. And finally, with those foundations in place, we are setting course to not to build an asset in Kathleen Valley, but to build a company, Liontown. Our strategy is consistent. We're not chopping and changing. It will be consistent. The first horizon is to maximise value at Kathleen Valley, bring it through its expansion phases to 4 million tonnes, drill out the resource so we understand its full potential. We will then move to our second horizon, which is the value maximising pathway through downstream expansion. And I'll touch on that in this presentation. And ultimately, the third horizon is to get Liontown to its full potential. Not only does that mean developing the downstream, but also our other mineral inventory in Buldania, an asset that's only in its exploration phase, which we're going to be spending further exploration dollars in order to develop its potential. ESG. I've mentioned the Jual. The Juals have been partners with us. We're the first company since Juukan Gorge to put down a native title agreement in Western Australia. We're very proud of that fact, November 17, 2021. They are partners all the way. They are participating in all our contract discussions, and we can see how we can further add value to the Jual people through education, training, job development to make sure that we bring together a sustainable model. Renewables. We're right in the final throes of our negotiations with a number of parties around our renewable commitment. At least 60% renewable from day one. We're not retrofitting a solar farm 6 years into production. We will have a hybrid, a solar farm, wind, battery backup with gas redundancy. 46 megawatts of renewable power, the biggest in Australia. The demand side. Look, I won't touch on this. You've had many presentations over the last 3 days around the whole EV situation. But what I will say, my own view here is, whilst there is talk of recessionary waves coming through Europe and North America, having discussed with customers at a very deep level around the requirement for raw materials, my view is if we move into that phase, there will be a change in mix around vehicles. My view is that the OEMs will focus more on EVs so that when they do come out of a recession, they'll be retooled and ready to execute their EV strategy. The supply. For me, there is two elements to this supply curve. Firstly, it fully factors in all the known supply expansions that are currently publicly announced. So that does have the million tonnes expansion that Pilbara is talking about, the Wodgina expansions that MRL and Albemarle are talking to, and there is still a deficit. The other point that I wanted to make here is the quality of the lithium units. When you talk to the suppliers, they will tell you delivering battery-grade lithium chemicals is not an easy transition. And we're seeing that firsthand in Australia. With the building of the refineries here, it will take time to build to that lithium quality required for the battery makers. So this supply of lithium units will be delayed. And as a consequence, the inducement price that is required in order to stimulate new production will stay at elevated levels for longer. That's the only way this equation will solve. Now, if you look at price, and we've seen all the reports around this oversupply presenting itself at the end of this year and early next year. Well, if you saw today's announcement by Pilbara with the current price of spodumene, I don't see customers waving those reports at me when I'm in negotiations with them. And if you can see with the graph on the right, the lithium commodities have held up strong relative to the other commodities. And there's a message in there. The other thing is we've plotted historically how spodumene has tracked as a percentage of hydroxide. Traditionally, it's sat around the 4%. But we've seen, since this new push of growth, that it's gone up as high as 11%. And today's auction by Pilbara gave it just over 9%. So there may be a structural shift occurring here where the new norm potentially has the spodumene price sitting between 7 to 9%. Now, the other question I often get asked are, can converters make money at the spodumene price? And I think the graph on the right demonstrates that they do make a healthy margin. And there's a second message in this. This demonstrates the investment thesis for downstream processing. The funding. We did the landmark 463 equity raise. We've secured 300 million Aussie of funding on very commercial terms with Ford. We've allowed for escalation. Our feed and our DFS was done during the hottest part of the market. We believe we've factored in reasonable escalation into our capital costs to give us the new figure of 545. We will also back ourselves through the management's capability, innovation and thinking. Where there makes sense that we apply escalation, we have. But equally, we want to make sure that the shareholders are getting the very best out of the management team, and we're going to deliver something that we can, despite. It would have been easy for me to pad this up by another 30% and blow the schedule out another 30% and blame COVID. But we're going to back ourselves. I see my project guys are just passed out, but they're sitting over there. Where's Tony said that from? Anyway, they know me well. Now, where are we positioned in the sort of capital intensity? We feel that we're very realistic, and this graph demonstrates that. We're in the middle. But there are also some other attributes of the project. Our flow sheet is very simple, uncomplicated, and we spend a lot of time thinking this through. It'll be modular in construction. We will take site hours out and put them in the capital cities and then transport the material or the modules in and build it like a Meccano set. Site hours is where you burn the time and the cost. What value proposition do we pose? I've just outlined the excellent foundations that we've put in place. I've demonstrated that we've got an execution methodology that we're going to hit hard. So then we look at the potential upside in value. And what this graph shows is a couple of things. So on the horizontal axis is production in 2024. So it has Pilbara at 680. It has James Bay included in Alchem, but it doesn't have us at 4 million tonnes, which is 700,000 tonnes of spodumene. So this is the outlook in 24. So the potential upside for Liontown shareholders and prospective shareholders. But there's also another overlay, our competitive advantage, the jurisdiction. We're fully funded. We're a globally significant asset, and we have the potential to go downstream. Again, one of the things that is instilled in our DNA from the chairman down is we need to deliver on our commitments. And this graph demonstrates the timeline and what we've promised to the market and what we've delivered on time. And we will continue, we will use all our innovation and ingenuity to continue to meet the promises to the market. At the same time, besides building Kathleen Valley, we have kicked off our PFS around the downstream, and we'll continue to prosecute the PFS at a slower cadence because the focus needs to be Kathleen Valley, but we're getting tremendous inbound interest from customers and other third parties around participating in that downstream strategy. Sorry, just one other point. First production is still on schedule to be Q2 2024. Now the whole project execution strategy. 75%, well, let me backtrack a bit. August last year, we did a 70 million equity raise. Part of that funding was to buy out the royalty from Ramelius, but the other part of the funding was to lock in long lead items. And we did that well before FID. So we ordered our mill, our SAG mill, which is the longest lead item, back in January, late January, early February. That has a 60-week delivery and it's on schedule. The same mill today, if we'd ordered it at FID, would be closer to 100 weeks. And we've done that methodically through the work my Chief Operating Officer, Adam Smits, has done in going through all the backbone of our flow sheet and ordered all the long lead items. So 75% of all the mechanical equipment has been ordered prior to FID. As I said, the DFS and feed were done during the points in time where they're elevated and hot market conditions, so a lot of those escalation factors have been included in the estimate. Now, we've made commitments to date of $125 million, and 85% of it is on a fixed basis. 40% of the total project spend is expected to be fixed price basis. The execution element, we've awarded to Lycopodium the whole EPCM, and we're going through, we've got our owners team in place, 80% of the team has been recruited, and we're finding that the lure of lithium or the future-facing minerals, we're attracting a lot of inbound talent from people wanting to understand this new sector and being part of it. So we're very encouraged about that. And the approvals, we've got our Section 18. We are out at the moment getting public responses on our native vegetation and clearance permit. So the 21-day period is almost over, so we're confident we'll get that across the line. And then it leaves us the mining proposal, which we're expecting in late August, early September. But we've started works. And we can see our people on site. And again, it's only fitting that the Jawar were part of the first turning of soil at Kathleen Valley. I mean, the design and schedule, I won't labour this point. I mean, we're well underway. I mean, we started FEED 1 week after we published the DFS. The ramp-up timing, the owners team, we've already got a mining team in place. We're continuing to grow that, and we're looking out to establish the operational team shortly. I'm running out of room in the office, but we'll have to work on that. And mining is planned to be 1 year at least ahead of production. We're building a 2.5 million tonne stockpile from 2 open pits. They will feed the plant in the initial 18 months while we sink the first decline. The downstream strategy. There are 3 points here. It is the value maximising pathway for Liontown as we currently sit today. It is strategically compelling, and I think that margin graph showed you that. And if you can imagine what the margin will be if we are an integrated supplier. And finally, we've got full optionality. Today, there is a wealth of experience being built in the West Australian engineering fraternity, with 3 refineries being built or commissioned at the moment. By the time we get to that point, we believe we will have access to those valuable resources, and we will get the benefit of the learnings that these people have had through A, building it, and B, commissioning it. We are getting tremendous inbound expressions of interest on the downstream. When you have a resource that has a 23 to 25 year mine life, it can underpin the capital required to build the downstream refinery. But we also understand our limitations. We want to bring in people that can do 2 things for us. Bring a balance sheet, but more importantly, bring know-how, so that we can work on it together and utilise their know-how and our quality resource. With the customer base that we've established, the transition to downstream is quite smooth. All these parties, LG, Tesla and Ford, were able to not only handle the spodumene, but transition over to chemical. Now, whether that chemical is hydroxide or an intermediary product, that's part of the PFS. Whether we locate it next to the site, in Geraldton or Kalgoorlie, that'll be part of the PFS. But the intermediary product brings benefits. Lower capital cost, no shelf life on the product, and we don't have to get that qualification for battery grade. And then we might build finishing plants with our partner in places, strategic locations around the world, and we would be transporting almost a fully formed product. The other point on this graph that I wanted to demonstrate is the optionality in Liontown. When we are in full chemical mode, we will still have further spodumene that we can sell on the spot market. So we can arbitrage any benefit there is on spodumene, but at the same time maximise value through the chemical sales. So that flexibility, I think, is unique. And at that, with 3 trains, we'll be one of the largest chemical producers in the world. So to wrap up, a Tier 1 asset in a Tier 1 jurisdiction. ESG positive. I mentioned not only the Joal Association and Partnership, that is a work in progress that we need to continue, but the renewable credentials, I believe, are a first for the industry, given that mix and that size for a company in our maturity curve. We believe we've timed it to perfection. There are views on supply and demand, but as I said, we've talked to customers every day. We understand, I believe, a closer understanding of what true supply is required than maybe most of the market. And then finally, the integrated opportunity. That value maximising pathway through downstream processing and the potential to feed that asset through Buldania, our second lithium opportunity. So on that basis, Jane, thanks to the audience for listening to me.
Thank you very much, Tony. We won't have any time for questions today, so we'll go straight to our next speaker, thank you, Tony,